All right, welcome in. I see people starting to connect. I hope everybody's having a great start to their day. Um, we're going to give people a few minutes to properly connect, and then we're going to get things started as 12 as planned. So I appreciate everybody's patience. Just another minute or so people can, who are still joining, can have a fair chance to connect, and then we'll kick things off. All right, that should be enough time. Hello, everyone. My name is William Mucker. I'm a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Repositioning Vintage Jersey Multifamily Properties, the Next Big Real Estate Opportunity with Aaron Fragnito of People's Capital Group. As a quick note, please be aware that we will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything presented in today's webinar is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Lastly, here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me, and I would be more than happy to help. Without further ado, I'll pass the controls over to you, Aaron.
All right, thank you, William. I appreciate it here. I'm going to share my screen and we'll get started here.
Absolutely.
And as William said, if anyone has issues seeing or hearing me through the presentation here, feel free to write in the chat or the Q&A. The Q&A is probably best if you have any questions as we go along. Please put them in the Q&A. I encourage questions. We'll answer all those at the end so we don't get held up here. And no such thing as a stupid question. So put it out there. I'll be more than happy to elaborate on any questions you might have. My name is Aaron Fragnito. I've been buying apartment buildings in New Jersey here and repositioning them with our in-house property management company through my company called People's Capital Group over the last decade, about 11 years now. And we are strictly focused on northern New Jersey. We buy and reposition apartment buildings between 20 to 50 units generally in cities that are within about an hour commute to New York City. So on the Jersey side, that's our specialty. And I'll explain how we find them, how we reposition them, and how we help investors build their wealth using their IRA as well. So let's get into it here. All right, so quick disclaimer, this is not a solicitation for funds, tax advice, or legal advice, but I will open up exactly how we reposition apartment buildings in North Jersey and why we see a good opportunity here, why we do North Jersey, right? A lot of syndicators focus on Texas or North Carolina or whatnot, where it might be a more landlord-friendly state or you get more real estate for your dollar. But let me explain why I think New Jersey is actually a great opportunity to build your wealth in real estate and how we've been doing this for over a decade for our investors. So today's agenda is finding discounted New Jersey multifamily properties for sale, underwriting apartment buildings. We'll get into that as well, really get into depth there. How to self-direct your IRA into real estate. Solving New Jersey's housing crisis. We have a serious shortage of housing here in New Jersey and creating passive cash flow. So I'll speak, by the way, for about 45 minutes to 30 minutes, and we'll open up for questions. Okay, so distressed, motivated sellers. So if you're looking to find deals yourself, okay, as an active investor, meaning you want to underwrite the opportunities, manage them, reposition them, sign the mortgage, and refinance over time, cash flow on the assets, sell them. If you're looking to do all this yourself, manage the contractors and the realtors and the management company and raise the capital and underwrite hundreds of deals to find one, then this is how we source our deals. This is how active investors source their deals. So one way is distressed sellers, motivated sellers. These are individuals that might be in foreclosure. Maybe their rate reset. Maybe they had a 2.8 mortgage rate from the days of very low mortgage rates, and it just reset now to 7% or something like that. That could be a very distressed seller. These individuals will be looking for a quick closing and also maybe assistance with closing costs, things like that, ease of closing. But most importantly, the security that you're definitely going to close quickly and effectively because they're up against the clock. That can be some of the best opportunities as a buyer to source discounted properties for sale, but you better have your ducks in a row and be ready to close because these sellers are in a tough position. You want to be able to you can perform very quickly as a buyer. A lot of times having a mortgage contingency, in fact, ever having a mortgage contingency in any contracts, they often get rejected. That doesn't mean you can't get a mortgage. We'll put in offers with no mortgage contingency, but we'll go get a mortgage to purchase the asset, raise capital over a few dozen investors to raise the equity for the acquisition and then close on the property in a timely manner. So, but we don't have a mortgage contingency in our offer, meaning if the property doesn't appraise well enough or the bank isn't able to close, then we don't get our deposit back, right? So we will use a bank to close, but there's not a mortgage contingency in our offer. And if you're making offers with mortgage contingencies, they're likely to get denied. Also, especially for a distressed seller, they're going to be looking for a cash offer. Again, a cash offer just means you don't have a mortgage contingency. You can still go ahead and get a mortgage to close if you have that timeline. There's also older owners. We've had a lot of success with marketing to older owners, generally through direct mail or telemarketing. This works for individuals generally over the age of 65 or 70s. They're retiring. They're looking to work less and just kind of cash out of the equity in their property. Maybe they've owned the property 10, 20, 30 years, and there's a good amount of equity in it. And these individuals are generally looking to move to Florida and retire. And they just want ease of closing as well. Less contingencies. Maybe you help cover their closing costs. They often don't want to pay for a realtor. And if you can give them a reasonably decent offer with decent terms, you may be able to buy some properties at a discounted price. They react best to direct mail and telemarketing. The under 60 owners tend to do better with online marketing, social media. Again, direct mail does work. It can be hit or miss. You can invest a lot of money in direct mail and get nowhere. It generally takes 7 touches for someone for you to get their attention as a marketer. So that can be through online ads, SEO, social media, direct mail. Text message marketing is very popular these days and tends to get pretty strong results. So I do find that texting is a little more affordable often than some of these other avenues where social media marketing and paid ads online can really add up, even with direct mail as well. Now, you're also up against a lot of competition in that space as well. So you're paying a good amount for ads. Lower priced properties, you're going to be sourcing those. These are maybe 6 units or less properties you're buying for less than $1 million, smaller multifamily deals. Wholesalers might have these. You can get them with banded signs. Those are signs stapled to telephone poles. That's actually how I sourced my first 6-family property in Newark, New Jersey. We bought for $220,000. We put about 60,000 to 80,000 renovations into it and refinanced all our money back out within 1 year. And the light bulb went off and said, "Hey, this is amazing. We still own this asset. We got all of our money back out of it. We're cash flowing on it. The money we got back out was tax free. And now that asset's worth about $1 million. It's a 6-family in Newark, New Jersey. The rent roll on it's about $9,000 a month. So it makes a little bit of cash flow as well. And we've refinanced it a couple times now, pulling out $250,000 or so each time in tax-free or tax-deferred refinance capital. So that's called the cash out refinance. And that's a great way to harvest some of your equity growth on a real piece of real estate you own, continue to maintain and own the asset and continue to get cash flow and tax depreciation from it. And most importantly, not pay taxes. You're not selling the asset, so you don't own capital gains tax. So we prefer to refinance our assets. And we bought plenty of lower priced properties through wholesalers and bandit signs. And that's bandit signs how I found my first deal there. That story. Mid to large properties. So generally now you're getting over $1 million purchase price, which is where we focus on these days with our equity fund. Our debt fund does buy smaller properties below $1 million, but our equity funds purchase larger properties. We're purchasing about an $8 million 42 unit right now in Passaic, New Jersey. We find these through brokers. Now, a good relationship with a good broker is a very, very valuable thing. The brokers we work with, they contact us as soon as they get exactly what we're looking for, which is a property between generally 30 to 50 units in northern New Jersey within an hour commute to Manhattan with rents below market value of 20 to 40%, value add opportunity, meaning they're mismanaged, they're underpriced and under rented. And we buy these properties at discounted prices with our investors. We reposition them with our in-house management company and we refinance or sell them over time. So we find these deals through brokers. We have great relationships with them. We've done over 300 transactions in New Jersey. So we close quickly. We don't nickel and dime them. And that's why brokers bring us deals off market. For example, the deal we're buying in Passaic was not on market. And we never buy deals on LoopNet or sitting on the MLS. We buy deals through pocket listings from brokers that haven't marketed them out to any other buyers. The best deals I ever bought were deals where we're the only buyer in the room. And that's how you get the price you're looking for when you're a buyer. And last one here, higher priced properties tend to be quality over quantity. If you're not working through a broker to get properties and you're marketing out directly to landlords to get those opportunities, you want to do kind of quality mailings where you're going to have a more sophisticated owner of a $10 million asset over a $600,000 asset, right? So you want to understand who are you trying to appeal to with your marketing piece and how do you best get in front of them. So you're going to maybe have to spend a little more money on the marketing piece and the list. The list is just as important, if not more important than the marketing piece, to be able to reach those higher priced properties and more sophisticated owners. Okay. So once you do connect with the seller, here's some tips on essentially locking up the deal for a great price. Always be closing here. So consistent marketing and branding. Again, minimum 7 touches it takes to get someone's attention for them to even know your name or your brand. Generally, it's more around 12 touches in today's market. There's a lot of noise. Okay, this could be social media, online ads, direct mail, so on. We've done billboards, right? The list continues. Provide solutions. So don't be salesy, right? So understand what the situation is with the seller. Maybe they have a certain timeline they need to close by. Maybe they don't want to pay for certain closing costs. Maybe they need the property sold 100% as is, which is generally always the case. Or maybe they want their cousin to live in the basement for another year, right? So figure out what the situation is. Generally, smaller properties, you're going to have more unique situations with, more personal landlords there. Be easy to work with, right? Be communicative, fast to respond, understand how they respond. Are they more of a person that picks up the phone, or do they prefer email or text, right? Again, that's going to depend on the demographic. Generally, older people are going to be more focused on more communication through phone. The younger demographic is going to be more text or email. And do what you say you're going to do, right? If you say you're going to close on a certain date, you say you're going to have an inspection, or make sure you do business with integrity in every matter of your business, of course. Some leads will take years, right? Some people aren't ready to sell just yet. They're testing the waters, they're dipping their toe in the water. So you want to be following up with them and consistent with them in this way or that way. Maybe every 90 days, reach out with a phone call or a message of some type, know the type of message they prefer, and stay in touch with them. People want to do business with people they know and like. So if you can be a consistent person in their life through a professional relationship, they're more likely to sell you that property for the terms you're seeking. Be ready when they're ready, right? So when they are ready to sell and say, hey, you know what? I had a health issue. I know I told you I wasn't going to sell for another year, but I need to sell now. I need you to close by the end of the month. Be ready to close, have your investor relationships in place. We work with over 100 investors, about 80% of them reinvest with us. So we're always ready to close on deals quickly. We have a debt fund, we have equity funds, we have the banking relationships as well. So we can close rather quickly on these opportunities. Okay. So how do we actually find most of our deals at the end of the day, right? We're talking about marketing and so on. Right now, these days, it is a seller's market. It's still a seller's market for commercial real estate. That means you need to know the realtors. You need to get those pocket listings, be the only bidder in the room. Now, when a realtor reaches out to you, they don't have that offering memorandum ready, right? They don't have that beautiful 20-page offering memorandum that goes through the market and the numbers. They're not there yet, right? They're just about to get a listing. The listing agreement may not have even be signed yet. They're just saying, hey, I know you're a good buyer. I know you close quick. We've done good business with you and other brokers in my network. I have this deal that's perfect for you guys. I know your buy box. We go out there that day or the next day. We submit a letter of intent, generally that same day. We understand what the seller is looking for. There'll be some negotiation, but for the most part, if we can get our price, and then we'll underwrite it very quickly with our underwriting team. But you're basically handed a rent roll, maybe a profit and loss, and you have to work from there. So you have to have good relationships with realtors, and wholesalers can be the same way, right? Wholesalers put a property under contract and assign the contract. Again, you're going to have to do your due diligence on all these fronts and make sure you're able to underwrite properties quickly and move quickly for great deals. And when you're doing business, be easy to do business with. These realtors and these wholesalers will bring you back the deals one-on-one before they blast them out to their list. We have 5,000 people on our list. I would so much rather pick up the phone and call one or two buyers I know are serious and going to move quickly, even if it means it goes for a little bit of a lesser price, but they're going to close quickly if we have a deal we need to move for whatever reason on our end when we're wholesaling an opportunity. So realtors and wholesalers are the same way. Auctions, we do online auctions, we do in-person sheriff sale auctions. I have to say the sheriff sale auctions are tough these days. There's a lot of people there. There's not as much inventory. In 2017 to 2018, we were making $1 million a year wholesaling properties, putting 2 a week under contract, flipping the contracts, making $30,000 to $50,000 on flipping contracts. There was a great amount of opportunity there, the sheriff sale auctions. But like any good opportunity, a lot of people found out about it and prices got bid up. And also there's just less foreclosures. The values of real estate have grown so significantly that quite frankly, there's less foreclosures. So there's less inventory going to the auctions. Landlords, we have good relationships with landlords, just like realtors and wholesalers. They'll come back to you once you do a good transaction with them and want to sell you more of their properties. Big landlords can have lots of properties, especially as they're getting to retirement age, and they can be a great source of discounted properties for sale. Of course, you avoid the realtor fee there as well. Ideally, get a better price. Attorneys, we work with a lot of attorneys, SEC attorneys, we real estate closings, commercial closings, LLC, corporate attorneys, all different types of attorneys, landlord tenant attorneys for evictions. So we have all these different relationships with multiple attorneys. We pay them a lot of money. So you better bet when they have a good deal hopefully they pick up the phone and call us, and that could be a great source of opportunities too. Contractors. So the last one here is we pay contractors a lot of money, right? Think about the people you're paying a lot of money to in your business. They are going to be the ones likely to say, hey, I have a good deal. We're buying a great deal right now. Newark right now, it's a small one. It's a 2-family, legal 2 with 4 units. We're actually just going to flip the contract, make a nice sizable wholesale fee on it. And we got that from our plumber, who we hire and give him, probably $150,000 a year, right? And for his business and his services, and he's a great plumber. But when he went to sell a property he owns, he called us first. So relationships are everything. That's how we source most of our deals these days. Out of the 300 transactions we completed here in North Jersey, we always make sure we're transparent, right? Not every real estate transaction is flawless. There's always challenges. You want to be transparent, communicative, a problem solver, and that's the types of people that other people want to do business with. So ease of business, working with integrity, closing quickly, doing these things will allow you to get more deals at great prices. And that's how we continue to source great deals. Okay, let's now dig into underwriting apartment buildings. All right, so now you've locked up a property, or actually before you even lock it up, you need to underwrite the deal, right? What do you even want to pay for this thing? Is it a good deal? All right, there's different levels of underwriting. We're going to go into 3 different levels here. What you do before you pay for anything, right? Complete the free stuff first, right? Before you pay for an appraisal or an inspection or anything like that, or environmental. Here's the free stuff that we complete first, okay? A profit and loss analysis, right? The money going in, the money going out. A sale and rental comps. You can do a lot these days through Zillow or other websites that allow you to just pull up comps pretty quickly. What are the buildings selling for that are comparable? What are units renting for that are comparable within that building? Competing builders' occupancy rates. So understand what other comparable buildings are they filled up, or are they 100% occupied, or are they having trouble renting their units and dropping their prices and have maybe a 90% occupancy rate or 80%, right? That's a red flag. The city occupancy rates in general. That's why we like working in high demand North Jersey cities where there is such an insatiable demand and such a shortage of inventory here. We'll get into that in a few more slides. And the demographics, understand who are your tenants going to be. Are you going to be renting to Section 8 tenants with this building? Or are you going to be renting to people that commute into New York City and make $150,000 a year? You have to understand who is your target demographic with this building. What is your tenant avatar? Your cap rate analysis. What are other comparable buildings selling for? What is their cap rate? Okay. A cap rate is a quick number that gives you, a higher cap rate will mean the building is less desirable, an older asset. A lower cap rate is for more desirable assets. It is a quick calculation that can allow you to, the NOI divided by the cap rate gives you the property value. So that's a quick way to kind of understand, hey, what's this property worth based on its net operating income? Now, remember, the NOI, the current net operating income, is not the whole story. If you're buying a building that's 70% occupied and mismanaged, but it's in a great location, you get for a great price, well, that's a value add deal. So its current NOI will be very weak. So therefore, its current cap rate purchase price will be very low, won't be maybe not penciling out as well, but you could say, hey, wait a minute, if I increase the value of the building by improving the units, creating more amenities, renting out vacant units, putting CapEx into the building, improving the management. Wow, now all of a sudden it becomes a much more desirable building with a much greater NOI. So an initial cap rate analysis does not always tell the whole story, especially if you're buying value add real estate. If you're buying core plus, cap rate analysis is more accurate. Find value add. You always have to find value add, right? Even if it's not really a value add play, you have to understand how much of the rent's below market value. What are some additional amenities you could put into the building? What are things that the management isn't charging for that you may be able to charge for or create value to the tenants and create additional revenue streams? Laundry in the basement, storage, other amenities, nicer amenities for Class A buildings, and so on. Tenant interviews. We do like to interview tenants when we're walking through the building. Not necessarily like a formal sit-down interview, but just understanding, what do the tenants have to say. Now, listen, take it with a grain of salt. Some tenants are going to be annoyed about things. But if every single tenant in the building is complaining about a leaky roof, or the heat doesn't work, or I remember we were looking at a building one time, and all the tenants were like, the hot water runs out after like 7 minutes, and all of them had the same complaint. It was a nice Class A building. That was an issue. We said, wow, we need to replace like all the water heaters in this building. So we wouldn't have known that, right, if you didn't talk to the tenants. So talking to the tenants can be a wealth of information. Landlord-tenant underwriting criteria. What is the landlord doing to underwrite the tenants? If they say, oh, I just do a credit search and that's it, well, then that's not good enough, right? They want to do background checks, employment verification, landlord references, of course, credit as well, income verification. So, and interviews with them, right? So you don't want to inherit a very difficult group of tenants, or maybe you do. Maybe that's the value add of the property, but you have to know that going in and get that right price for that opportunity. Supervisor interview, the super of the building, right? That guy's going to know a lot. He's the guy running around fixing everything. Now, he works for the seller, right? So he might bite his tongue, but at the same time, you talk to him enough, you take him out for a coffee or a beer, that super is going to really be able to open up on that building and say, here's the tenants you got to get rid of. Here's the good tenants. Here's the boiler breaks every December on the Christmas Eve. And, so they're going to be able to really open up on the building. HOA bylaws, if that's applicable, you want to look at the HOA, understand them. Talk about a boring contract. Okay, so how do we underwrite apartment buildings? Now, the next step is we complete these once we're under contract, okay? Physical inspection of the building, you always want to hire an inspector, try to get in as many units as possible. OPRA request, that's Open Records Act request. You'll find open permits with that. Any environmental issues like oil tanks, things like that may be in the OPRA request as well. OPRA requests can take up to 4 to 6 weeks, depending on the city. So you want to do that right away. That is free. You can do an OPRA request. Probably I could have put that on the first slide. Environmental phase 1. So that would be an oil tank scan of the property. You'd be amazed how many oil tanks we've found on these assets. You always want to be doing a scan of the property to really understand what's going on. If you find an oil tank, then you may have to do a phase 2. That it consists of soil tests. And you can have more environmental issues beyond just a oil tank, but oil tanks are the most common one. We also asbestos. You're going to find a lot of asbestos in these older properties. And that's not a major issue. You just have to hire a contractor to properly get rid of it. Review of trailing 12s, that's rental collections and expenses. Generally, you want to go back at least 12 months. 36 months is great. Not all landlords are going to have that. Some landlords aren't even going to have 12 months, right? They're going to say, oh, I don't keep good records. Everyone pays their rent. Just don't worry about it. Here's my last PSE&G bill, right? So, but you want to get at least a trailing 12. Any agency debt like Fannie Mae, Freddie Mac, they're going to require a T12. And that's going to tell you a lot about the performance of the asset, the expenses on the asset, and will probably poke holes in the seller's story and their numbers when you finally look at the trailing 12. Sellers' accounts receivables, who owes them rent, right? Who's not paying rent, right? That should usually be disclosed when they send you a rent roll. That any good landlord keeping good records with any reasonable management software is going to show accounts receivable for the seller, who owes them rent. Staffing agreements, right? What do they pay that super? How about the people that clean the hallways, take out the garbage, plow the driveways, cut the grass? You want to review all those, understand. And there might be opportunity there to make more NOI as well, or lower your expenses, essentially, right? I mean, we've looked at buildings where we have a situation where the guy who does the snow removal or landscaping is getting paid way too much, right? And you recognize that. Don't tell the seller that, right? But that's going to be something you'll change once you own the asset, right? But make sure maybe that landscaping agreement has 14 more months on it or something. So you just want to recognize that issue too. I've seen people hire family members at crazy prices also, so you got to be aware of all that. Review the leases, the lease extensions, work orders, utility bills. It's pretty straightforward. The state green card in New Jersey, every 5 years, there's an inspection for any building 3 units or greater. Does the seller have the green card? If they don't, have they done the inspection? How much is owed in fees to the state if they don't have the green card, if they haven't done it? If they say, what's a green card? Call the DCA and figure out how much is owed on that property. And if, by the way, if you're buying the LLC, if it's an LLC purchase, so you're buying the property through buying the LLC that owns the asset, and the seller doesn't have the green card, and we did this one time. We purchased a property. We knew the seller didn't have a green card, but we didn't know how much was owed to DCA. They didn't really get back to us in time. We had to close quickly. And we were buying the LLC to, I think we had to buy it. It was some type of flip situation or a wholesale deal. So we ended up buying the LLC, the existing LLC that owns the property. We hate doing this. We don't do this anymore. And since we purchased the LLC to purchase the property, we found out a couple months later, the DCA sends us a $20,000 bill saying, oh, the last owner or the owner of this LLC didn't get the green card for years. And we've been fining him year over year. We just didn't notify anyone. And now here's $20,000 owed to us. We had to get an attorney and fight it. I think we settled in the middle. But purchasing LLCs that own the asset is a risky move. Talk to your attorney. Certificates of occupancy, that's always a fun thing for the, we always ask sellers to get C of Os. I mean, there are scenarios where the buyer has to get it because it's an as-is sale. That is part of the negotiating process, but always try to have the seller get the C of O. C of Os can be tough. There's city inspections that they go through the whole property, and depending on what side of the bed the inspector woke up on, you may have a lot more repairs than you think. So always ask the seller to get the C of O. Generally, banks require them as well. Service provider agreements, we talked about that, landscaping, service providers, snow plowing and so on, garbage removal. You can save money there. And that's a great place to really shop around and figure out, has the seller been using the right service providers, or can money be saved there? That goes right to the bottom line. Okay, so the final level of due diligence, now you're essentially closing on the asset. You want to do, of course, a title search. Attorney legal review, okay, of any additional documents. Your attorney is going to be involved in really the last slide in this slide. Environmental phase 2, if necessary, that's going to be soil tests and so on. Appraisal, if you're closing with a bank, you're going to want to get an appraisal done. Heck, even if you're not closing with a bank, you should probably get an appraisal done just to get a third-party opinion of value. And the bank's attorney legal review, right? So you're paying not only your attorney, but you're also going to be paying the bank's attorney to review legal documents and help you get to a closing table. But listen, the more eyes you have on an opportunity, the more professionals you have reviewing it, appraisals, inspectors, attorneys, and so on. These people are going to help you make sure you make the right choice in what you're purchasing, especially if it's the largest asset you've ever purchased. You got to make sure that you have professionals guiding you through every step. It's better to spend a few $1,000s on an attorney and an appraiser and so on and kill the deal. We've done that before. Unfortunately, it's part of the business. Then go through with buying a $4 million building that you ended up overpaying for, or there's an environmental issue, or there's a title, right? So you want to make sure that you're hiring the right professionals to do these transactions. Okay, how to self-direct your IRA into real estate. So here with this property, with this process, I'm sorry, you want to make sure you have the right IRA custodian for your goals. Camaplan is the one to go with. If you haven't already signed up with them, they are awesome. We work with them. We have a number of common clients. And so select your IRA custodian, give Camaplan a call there, create your account with them. It's very easy. You can do it very quickly. It really takes just a couple days. I believe we have a promotion going with them where it's like $50 or something like that, or even with Joe and I, he had a link at one point. I don't know if they're still doing this promotion, but it was $1 to start an account. I think that promotion passed, but it's still a very affordable to start an account and very affordable to maintain an IRA custodian account as well. So the custodian will request the amount of capital you're seeking to move from your current IRA holder, say Fidelity. Okay, you say, okay, I want to invest $100,000 in People's Capital Group's apartment building acquisition that they're doing in Passaic, New Jersey. So Camaplan will contact Fidelity. They'll say, okay, we want to move $100,000 from Fidelity into Camaplan, into the IRA account you've created. That takes about 2 weeks to happen. At the same time, as that money is moving from Fidelity to Camaplan, Camaplan is going to contact us, People's Capital Group. They're going to say, we need to review your PPM, your private placement memorandum and subscription agreement, and any other LLC docs they require. You want to make sure if you are investing with another operator that they are IRA friendly, that they understand this process. Now, about 40% of our investors self-direct their IRA into real estate with us. but you want to make sure that the documents they have are IRA friendly, are going to pass the approval of the IRA custodian. Okay. Now, your IRA custodian CAMA plan, they're not going to tell you if this is a good investment or not, or if they like the operator or not, but they are going to tell you if you're able to self-direct your IRA into this opportunity. Okay. So once the IRA custodian, CAMA plan in this case, approves the documents and the money is moved over to CAMA plan, then CAMA plan completes the investment into the fund. In this case, it would be PCG Fund 3 in this example, and then we go ahead and close on the asset. Now, as that investment creates cash flow, those cash flow checks go back to CAMA plan, back to your IRA custodian. Okay, they don't go to you directly, right? Because that would violate the IRA rules. So as we do a refinance and we have a big liquidity event, again, that goes back to your IRA custodian account. When we sell the asset, there's a final liquidity event that goes back to your IRA custodian account. So it's not a way to pull out of your IRA and beat the tax man, but it is a way to take control of your IRA, self-direct it into real estate, ideally grow it faster than some of the other stock investments that are available, and truly diversify out of the stock market into real estate, into an asset class that is not contingent and does not correlate with the stock market, right? It's not a REIT, it's not a stock that's backed by real estate. It's a specific property with a specific strategy that produces cash flow, refinance proceeds, and sale proceeds. So a lot of investors take about 30 to 50% of their IRA and they self-direct it out of the stock market into real estate. That's a very common asset class to self-direct your IRA into. Okay, that's the process of how to self-direct your IRA into real estate. So let's talk about solving New Jersey's housing crisis. Okay, a few more slides here and we'll wrap up for questions. So market drivers, what are we seeing right now? This is the New Jersey market that we specialize in. Well, lowering interest rates, they're expected to continue into December here and really into 2025. Now, as the Fed drops their rates, actual mortgage rates trail about 90 days behind that. So we saw a little dip in mortgage rates and they kind of shot back up. What was happening there was the Fed dropped rates, everyone got excited, ran out and got a mortgage, and that actually causes rates to go up because more demand, it creates rates to go up. Now, as that initial excitement running out to get the mortgage slows down, rates should continue to drop, and the Fed should continue to drop rates into 2025, although that, of course, remains to be seen. Here in New Jersey, one of the reasons we've been investing here for over a decade and building our investors' wealth is because there's very low vacancy. It's an extremely high demand market. We have a shortage of 214,000 affordable units. The rental vacancy rate is 3%. Okay, that means the occupancy rate is 97%. Only 3% of units are vacant. That is the third lowest in the nation, right? You want a low vacancy rate, right? So that's very good. That means it's a very high demand market. There's also low inventory. New Jersey has had a 43% drop in new housing permits from December 2021. Okay, so just a big slowdown in new development of housing here, and of course that's going to cause prices to go up. Right? Less supply, strong demand means prices go up. Basic economics. 48% less homes are on the market from January 2020. So we're not building enough houses. And we're also not enough people are listing their homes for sale. So the reason we're not building more real estate right now is because rates were very high for an extended amount of time. Since around end of 21, rates started to go up. So developers and builders, they no longer have that incredibly low interest rate. Construction loans are notoriously high interest. So the deals just aren't penciling out. So there's less real estate development going on. Now, as rates come down, that should fix itself. And we should see more development going on. We're already starting to see that, in fact. However, with 48% less homes in the market, the reason no one's listing their home as much is because of the lock-in effect. What that is, if you have a 3 or 4% interest rate and you don't need to sell your home, then you're really not going to sell your home, because if you do and you go buy a new home, you're getting a 7% interest rate. So who in their right mind would trade in their 3.5% interest rate for a 7% interest rate? You're just going to be buying a lot less home. You're going to be moving into a smaller home. That kind of defeats the whole purpose, right? So if you don't need to sell your home, if it's not a health issue or a job relocation or just a situation where you have to sell your home, then you're really not going to sell it, right? Now, of course, people still need to sell their homes. They have another child, right? There's always scenarios where homes need to be placed on the market. So they are, but still 48% drop in homes in the market from January 2020 is huge. Less inventory means prices go up. Okay, solution to New Jersey's housing crisis. So first of all, we need to build more real estate. Here at People's Capital Group, we are looking into building more real estate. We are working with some of the best-in-class builders and developers. We're bringing in equity groups and high net worth individuals and family offices and accredited investors to invest in these opportunities. And we are looking at a number of new development opportunities in New Jersey here. Repositioning. So we take old mismanaged apartment buildings and we improve them. We give them better amenities. We renovate the units. We improve the management of these assets. And we take these older apartment buildings and make them more desirable places to live, therefore increasing the net operating income on the asset and refinancing or selling them over time to create liquidity events for our investors. And of course, invest, right? And investing in real estate, I invest in real estate, our investors invest in real estate. Without capital behind us, we can't continue to develop and reposition and create more quality housing for New Jersey residents. And that's our goal here at People's Capital. That's why we focus on this market. There's a shortage of inventory. There's such an insatiable amount of demand, and we need to saturate that demand by creating more housing and more quality housing of vintage assets. So our investors, they create passive cash flow working with us here at People's Capital Group, but there's lots of ways to create passive cash flow. There's lots of real estate syndicators out there. There's big ones, small ones, ones that focus on an entire nation, others that focus on specific markets. Vertically integrated management companies, vertically integrated real estate syndication companies that have in-house property management like ours, and other companies that hire third-party management in different markets, right? So you have to find out what's the best fit for you for your investment goals. But most people start investing in real estate passively because you want to team up with experienced operators that have a history of completing successful transactions and getting the returns to their investors that they initially targeted and have integrity in their business dealings. So find a team that can source off-market, great discounted properties for sale, can build value into them over time, and create liquidity events for you down the road and cash flow consistently into your bank account. Consider self-directing your IRA, right? I think 95% IRAs are not invested in alternative assets. So real estate is the most popular alternative asset to self-direct your IRA into. It's quite a tried and true asset group. So take a look at your IRA or your 401k. Talk with Camaplan. Figure out the processes. It's pretty easy. It's pretty affordable to self-direct your IRA. Don't move all of it, right? But take maybe 30% of it. Invest in real estate passively and start truly diversifying out of the stock market. 1031 exchange, right? Maybe you own a property that's gone up in value. If you've owned a property for more than 5 years, it's probably worth a whole lot more than it was 5 years ago. So look at the possibility of selling that asset and doing a 1031 tax deferral into another asset. You can invest passively into opportunities with active operators, right? So we accept 1031 capital into our apartment buildings. In fact, we're buying 12 condos for a great price in Long Branch, New Jersey right now. And we're bringing in one 1031 investor at $1.5 million. And we're going to own that asset with that investor. We're going to refinance a year into the investment, get back about 40% of their capital within a year, and then cash flow on the asset and refinance 5 years after that and get back another 40% or so of their investment. So we work with 1031 capital. That can be a great source of creating passive cash flow and passive income for you if you're tired of being a landlord of the property you own. Consider investing in new development with a 2-year lag in new development due to high interest rates. Investing in new development now will likely pay off in the future. So again, I think new development is a great space to be. About 25% of the real estate on the market right now in North Jersey is new development real estate. So that is an interesting number. It's normally around like 10 to 12%. '24. That'll grow our assets under management to $40 million. That's a 42-unit apartment building we're closing on in Passaic, New Jersey. We have a couple spots left, but that one's pretty much filled up at this point. 2025, we'll refinance 2 or 3 assets, creating a liquidity event for many of our investors. Our goal is to raise another $10 million to $20 million and acquire a $20 to $40 million asset in 2025. In 26, we look to raise $25 million and acquire about $50 million in assets. In 27, we look to raise about $50 million and acquire $100 million in assets. We have relationships with equity groups, family offices, and high net worth individuals. That's how we plan to get there. In 28 to 29, we're going to begin harvesting those assets that we've purchased over the last 4 years and create liquidity events for our investors. Who invests with People's Capital Group? We work with C-suite executives, usually working 50 to 60 hours in the city to support their families. Very busy professionals that are looking to get some tax benefits with real estate, passive cash flow, and just build their wealth more aggressively. We have police officers servicing our community and sheriffs as well. We have a debt fund that allows for non-accredited investors to invest in. Teachers, again, great for our non-accredited investors. They often invest in our debt fund. Mothers and teachers helping educate our youth. Doctors, physicians are very popular. We have great relationships with a number of physicians that are super busy, get nailed on taxes, and they're looking for a tax shelter. They're looking to be able to look at an opportunity quickly. They don't have the time to review hundreds of deals like we do or do all the in-depth underwriting. They want it explained to them quickly and easily to understand, and they want the investment process very easy as well, which we do all right online through our investor portal. And doctors really enjoy that passive cash flow, the tax-deferred liquidity events on the refinance, and the tax benefits in general of investing in real estate. And just professionals in general, lawyers, accountants, engineers, insurance specialists, IT specialists, business owners, entrepreneurs, authors, managers, all seeking to make their hard-earned money work harder for them through passive real estate investments. And why do we invest in real estate? Last but not least, I personally invest in real estate to create legacy wealth. I have a 3-year-old son named Dean. He's the love of my life, the most important thing in my life. And I want to make sure I can create a better life for him, but also leave something for him. As they say, you can't take it with you. So the idea of legacy wealth is incredible. If you invest properly and aggressively, and you make the right investment decisions, and you team up with the right professionals through a lifetime, you can create an amount of capital and wealth that is just incredible here in America. So you can create legacy wealth and hand that down to your heirs, or have an impact on issues you really care about and be a philanthropist. It's one of my goals as well. I love donating to World Vision, my church, and other nonprofits that make a real difference in this world. And let's be honest, right? Money is power. So being able to invest well and make good returns and be a philanthropist in this world, that's one of the most powerful things you can have to create a positive impact on our world. And also work less and enjoy life more, right? When life goes by way too fast, we work really hard here in America, and we work long hours, early mornings, late nights, and it's important you take some time off and enjoy time with loved ones and families, especially through the holidays now. And by creating passive income, you can actually do that and have more of a work-life balance and preserve our wealth long-term, right? The idea of investing in, I remember I invested in cryptocurrency. I still own a lot of cryptocurrency. I don't hate it that much, but I invested in Voyager, and I didn't really understand it. And I broke my golden rule of investing in things I don't understand. So I invested $35,000 in the Voyager app through a bunch of cryptocurrencies I didn't really know anything about, a bunch of altcoins. And then Voyager filed bankruptcy, and my $35,000 turned into $2,000. And it was just scary. It was a wake-up call to me that, hey, what am I doing? I'm investing in something where my wealth is not preserved. It can just disappear overnight. There's a reason most of my wealth is in real estate, because it is insured, it is backed, there's a ton of tax benefits as well. So I really protect my wealth, and I preserve my wealth, and I grow it through time. And same with our investors. And that's why we love real estate, because it's tried and true. The tax benefits are phenomenal, and it's a great way to preserve your wealth. That's why about 60% of billionaires' wealth is invested in real estate. So last but not least, thank you to our investors. We are only successful as we make our investors, some of them might be on the webinar here today. Since 2013, many people have been investing with us for over 10 years here. Seth Martinez, my business partner, and I started our company in 2013 with the vision to help people preserve and build their wealth through real estate, particularly North Jersey multifamily real estate with value add opportunity. So we would not be succeeding without the support of our loyal investor base. About 81% of our investors reinvest after the liquidity event. That's due to consistent communication, monthly updates, quarterly financials, but performance as well, quarterly cash flow distributions, large liquidity events upon refinance and sale, and doing what we say we're going to do is the most important thing. So whether you invest with People's Capital Group or another operator, if you are investing with operators as a passive investor, make sure those operators work with integrity, have a good track record, have been around a while. It helps to have vertical integration, meaning an in-house management company, because we've hired third-party managers in the past and it's been a struggle. So it's usually a good alignment when they have in-house property management. Most of all, a good performance history is the most important thing, and work doing business with integrity. So that's it for me, ladies and gentlemen. Let's look at our questions here. We'll open up the chat.
Yeah, absolutely. Great presentation so far. So yeah, please ask any questions in the chat and or Q&A function while we have Aaron with us. There was one that came in a little bit earlier from Gary. He wanted to know your minimum investors and minimum investment, and if you need to be accredited to make an investment.
Sure. So our minimum investment for our equity fund is $50,000. And you do have to be accredited to invest in that. Okay, what an accredited investor is means you have a net worth of $1 million, not including your primary residence, or an income of $200,000 individually, or $300,000 including your spouse. That's an accredited investor. Now, we do also offer a product to non-accredited investors. We offer this to sophisticated investors. This means you have experience reviewing or underwriting or investing in real estate opportunities. You have the means to not have to live on the returns of the investment. You have additional savings and income. And we have a debt fund just for those types of investors, where investors earn 8 to 11% annual interest payments. And the minimum of that is $30,000. So again, the debt fund minimum is $30,000. You don't have to be accredited. You earn quarterly interest payments on your investment. The equity funds, you do have to be accredited. The minimum is $50,000. And those often target higher returns, but there is more volatility to equity investing.
Great. That's the only question at the moment. So please don't be shy. Ask your questions. In the event that somebody watching this recording after the fact or somebody wants to ask you a question online, is there a good way where people can reach you?
Absolutely. Yeah, I just put in my link there for my Calendly, and I'm also going to put in here my email. Okay. So yeah, the best way to connect with me is probably to schedule a call through that link I just put in the chat. We can schedule a call that works for both of us, and we can talk about investment goals and what we do here at People's Capital Group, or just about the New Jersey real estate market. We've done 300 transactions here, so if you have any questions, more than happy to answer them. You can also shoot me an email at aaron@peoplescapitalgroup.com. I can send you more information on what we're working on right now, especially this 42 unit we're purchasing in Passaic, New Jersey. Like I said, we have a couple of spots left on that. We'll be wrapping that up over the next few weeks, but a great opportunity we're looking forward to closing on. But yeah, we work with all different types of investors, people doing 1031s as well. Even if you haven't listed your property for sale, you're just thinking about selling, now's the time we actually need to connect and kind of talk about that if you want to team up on a 1031. But definitely talk to Camaplan here. We love working with Camaplan. William, you guys are great. We have a couple common clients together, and you guys are one of the best IRA custodians out there. So we work with a good amount of IRA custodians as well, right? About 40% of our investors use a self-directed IRA to invest in real estate with us. So we work with a lot of IRA custodians, and they're not all created equal. Some are difficult, slow, expensive, right? So keep an eye on that. I think Camaplan's a great option for you.
We really
Um,
we really appreciate that, and we're always happy to help answer any questions about your self-directed IRAs, run through different scenarios you're thinking about, and we always answer the phone. So, very appreciative of the kind words. And it does look like another question actually came in. What is the source of your key drivers?
oh, the key driver slide. So, yeah, I actually got that from a online here. It's from I'd have to look back and see. If you just go to if you Google, the New Jersey affordable housing shortage and Jersey vacancy rates, you'll find it pretty prevalently there. As far as the other one, I found a reputable economics site that had all the data put together. I can send that to you if you'd like. If you want to shoot me an email, Frenchie, then that's the best thing to do. Send me an email there, and I can get you those exact websites that I got this information from. It's not a problem. I always try to get very reliable sources here. If I'm on a website that I haven't heard of or something that doesn't look right, I don't go with the information. But if it's a reputable site, then I do go with it. But I'm normally sourcing these online.
All right. Thanks for all the questions. Thanks for your time, Aaron. I think people have some processing to do, but I'm sure a lot of people will be reaching out to you directly after the fact. Highly encourage it and highly encouraged anybody who's watching this recording later or who may be in the presentation today. If you have any questions, again, if you have any questions about your self-directed IRAs or your goals, please give us a call. We're always happy to help. And thank you to Aaron and thank you to everybody who attended or may be watching this recording in the future.
Thanks, William. If you could send me that recording as well, that'd be great. All right.
Absolutely. We will do. All right. Take care, everyone.
Good day.